Welcome to the Virginia Civics and Economics Lecture Series. At the end of each slide, there will be a 5-second delay. Use this time to complete your notes. When you are done, push play and move on to the next slide. This presentation will begin in 5 seconds. Welcome to Virginia Civics and Economics Lecture 2.6 on private financial institutions, and let's ask, where should we keep our money? I mean, he's got a nice chunk of change there. But should we leave it in our jar, like this young man? Or should we put it in our car? That doesn't look too safe. How about something more traditional, like a piggy bank? This doesn't look too secure either. Well, we could always do the old hide it under the mattress trick, and all it does is sit there. So we need to ask, is there a better way to secure our money and maybe get more out of it? In other words, can we get Green Lantern and the Flash to actually do something while they sit in the bank? We're going to look at that today, and with that said, let's go to the next slide. Banks are an everyday part of our life, yet many of us don't truly understand the impact that banks have on society. So to understand that impact, we're going to look at the role of a private financial institution. The primary role of a financial institution is to receive deposits and make loans. In other words, banks do the following. They accept deposits from consumers into savings and checking accounts. They process checks by making sure that the money being taken out of one checking account gets paid to the account of the person depositing the check. What do these two things mean? Well, I'm going to take my money and the bank's going to hold it for me. But at some point, I may need to pay somebody else. I'm going to give that person a check. That person's going to go to the bank and say, hey, I need the money in that person's account to go into my account because he owes it to me. That's what banks do. Banks also manage and offer access to consumer accounts, things like ATMs and online banking, and banks make loans or provide credit to consumers for homes, cars, colleges, and credit cards. And here's the cool thing. We are consumers. We go to retail banks. When you go to that local bank branch, that's a retail branch that works with us. Businesses, they are commercial bankers. They go to commercial banks to get what they need. But both types of banks offer similar services. That's not all, though. You see, we have to talk about vehicles. Not that type of vehicle. Banks also offer products known as vehicles for their consumers to invest their money and hopefully make a profit off of their investment. Here's how this works. There is risk involved in investing money. You may lose your money on a poor investment, and it is up to the consumer to determine their comfort level of risk. In other words, I think I want to give this money to that person so they can take that money and use it for a certain thing. And I hope that in the end, I'll get my money back plus some extra money in return. Well, you have to be comfortable. You might get a great return from your investment, but at the same time, there might be a lot of risk and you might lose all your money. So you have to balance your risk. Are you comfortable enough to lose all of this money in return for the possibility of a great investment? So, examples of vehicles for investment include buying stocks, allowing people to use your money to manage a portfolio of stocks. That's somebody who says, I take all of these different stocks and put them together, and I make money on them as a group. Investing money in vehicles with tax benefits to the consumer, like individual retirement accounts. That's how I save my investing for retirement, or 529 plans. Those allow people to save for college. So I put money away in a 529 plan so that eventually when my children go to college, that money will be there and I will have made extra money and I can use all of that to get them through school. Go to the next slide. Now that we've explored the role of financial institutions, we need to see if all financial institutions work the same way. Guess what? They don't. Instead, there are 3 types of private financial institutions in which people can place their money in the United States. The first are banks. Those are businesses authorized by the government to accept deposits, pay interest, process checks, make loans, act as an intermediary or a middleman in financial transactions, and provide other financial services to its customers. The majority of private financial institutions we see in this country are banks. But there are two other types of private financial institutions that exist today. The first are savings and loans associations. They are specialty banks designed to promote affordable home ownership by paying lower interest payments to depositors in exchange for better rates on home loans. Think It's a Wonderful Life. I'm putting my money in this bank because at the end of the day, the whole idea is for me to save enough money to buy my own house, and I'm going to do it through this savings and loan association. We also have credit unions. These are democratically member-owned cooperatives. What does that mean? It means the people putting their money into the credit union actually own a piece of the credit union, and they are designed to promote thrift, credit, and financial services to its members. You've seen a lot of these. Navy Federal Credit Union, the Virginia Beach Teachers Credit Union. These are a group of people from a similar job area, and they've come together and they've said, let's all pool our money together in this credit union in order to make it cheaper for us to do our banking in this country. Go to the next slide. Our economy doesn't work without the existence of private financial institutions, but the banking system works only when consumers and private financial institutions have confidence in the system. No confidence equals fail. The banks aren't going to lend us money if they don't think they'll ever see that money back, and we certainly are not going to put our hard-earned money in a bank if we don't think we'll ever be able to get it out of the bank. So we have created some things so that we have consumer confidence in banking. Consumer deposits, that's the money we put into the bank, are insured. That means that they will be paid no matter what happens to the financial institution, and they're insured up to $250,000 by the federal government. The Federal Deposit Insurance Corporation basically says to everyone, you can put your money into any bank in this country, and we will make sure, no matter what happens to that bank, that your money up to $250,000 will be yours the next day after that bank falls apart. But this is a two-way street. Financial institutions provide two types of loans, and the type of loan provided by the bank becomes important if a consumer files for bankruptcy. That's running out of money and trying to get rid of or discharge your debt. Secured loans, these are things like mortgages, which we use to buy our houses, and car loans, must be repaid by the consumer, even if the consumer files for bankruptcy, and these are usually secured by something called collateral. Think of your money as being locked up. It's the money that you can use, but you've used something like your house and you've said, hey, if I don't repay this money, I'm going to use my house as collateral. If you secure your loan with your house, the bank may sell your house to get its money back. There's also unsecured loans. These are things like credit cards and personal loans, and they may get paid. You may have to pay the bank back that money if you file for bankruptcy, but only if there is money left over after the bankrupt person pays off his secured loans first. So, secured loans get paid first, everything else gets paid second. We have one way to make sure that we have consumer confidence in the consumers, and we have another way to make sure that we have consumer confidence in our financial institutions. Go to the next slide. Remember that whole confidence thing we just talked about? Well, what if I told you that the money you put in your bank doesn't just get locked up in a vault? You see, there isn't enough money to go around. So that money that you just gave your bank is going to be used by the bank to help somebody else get something, to get a loan for a house or to get a loan for a car. What is going to encourage you to invest that money in the bank? Because you could just leave it under your mattress, though that's not very safe. Think of it like this. Here's your money. It's a plant. How do we make our money grow? How can the bank encourage investment? Private financial institutions encourage savings and investing by paying interest on deposits. Here's how it works. Traditionally, the bank pays you back a percentage of what you put into your savings account. Let's say I put $100 into my savings account. At the end of the month, the bank will pay me 1% of that $100. I end the month with $101. And in exchange for me making that extra dollar, the bank has used that money I put in there to help somebody else secure a loan for a house. Banks also encourage investing through vehicles that often have a high rate of return but carry more risk, and your overall money may decrease or disappear entirely on a bad investment. For example, this is our retirement. We call it our nest egg. We want that little egg to mature and grow so that when we retire, it breaks open and all this money pours out. Well, if you invest poorly, you're going to ruin your nest egg, so you have to be careful. Here's another thing. Deposit interests are smaller for checking accounts than they are for savings accounts, and there can be fees on a checking account. So if I'm just putting my money in a savings account and all it does is sit there, the bank's going to give me more interest. If I have a whole checking account and I'm pulling money in and out and I'm paying money off of that thing, it's not going to make as much money. And finally, interest payments on deposits depend on the health of the overall economy. If we have a strong economy, you're going to get a higher interest rate on your bank deposits. If we have a weaker economy, you're going to get a lot less. That's it for this lecture, and I look forward to seeing you in class.